Here's Bitcoin to gold. Bitcoin is starting to outperform gold again. Gold peaked January 28th, the day that Warsh was announced as the next Fed chairman, if Congress approves him. And he is slightly hawkish. So Bitcoin has been moving up relative to gold. That's interesting.
One of the most striking trends Cathie highlights is the renewed outperformance of Bitcoin relative to gold. Historically, gold has been the go-to safe haven during uncertainty, wars, inflation, currency instability. But now, Bitcoin is starting to reclaim that role. According to Cathie, this shift began after gold peaked around late January, coinciding with expectations of a potentially more hawkish Federal Reserve leadership. Since then, Bitcoin has steadily gained ground. This signals something deeper than short-term price movement. It suggests a structural transition in how investors perceive value storage. Bitcoin is no longer just a speculative asset. It is increasingly being treated as a digital alternative to gold, especially among institutional and forward-looking investors. And this trend becomes even more important when you consider the broader macro environment.
Here's Bitcoin to gold. Bitcoin is starting to outperform gold again. Gold peaked January 28th, the day that Warsh was announced as the next Fed chairman, if Congress approves him. And he is slightly hawkish. So Bitcoin has been moving up relative to gold. That's interesting. And then just the last two or three charts here. This one is still a puzzle. Why is that green line, metals to gold, still going down? Is it China? Is something really wrong in China? I don't know if it's just China, but it is puzzling, especially now that the gold price has gone down from nearly, I think it was almost, was it $5,600 down to $4,400. We haven't seen a clear turn in this variable, which is quite interesting. It used to correlate very well with the 10-year Treasury yield, which you see in purple there. They parted ways in 22 when the Fed started tightening, and I would say when central banks started buying gold and selling dollars. And again, the yen carry trade unwinding starting in the summer of 24. So all of those should be in there now, and my guess is that the 10-year Treasury yield is probably going to fall because we've had a lot of major forces pushing it up, not the least of which has been the recent flare-up in commodity prices. If we're right and the supply side of the economy is coming to the rescue, we're probably going to be surprised at interest rates coming down as opposed to going up.
Cathie addresses two types of deficits. One, government deficit, spending versus revenue. Two, trade deficit, imports versus exports. While policymakers often worry about these figures, Cathie argues that they must be viewed in context. A booming economy tends to import more goods, naturally increasing the trade deficit. But at the same time, strong growth attracts foreign investment, creating a capital surplus. In other words, trade deficit economic strength, capital surplus global confidence. This flips the traditional narrative on its head.
And here you can see in the prediction markets, one of the questions we put in is, will the U.S. federal deficit to GDP ratio drop below 5% for fiscal year 2026? Now, fiscal year means through the end of September, so the year through September of 26. And as you can see here, as the war in the Middle East has extended, the odds that the debt deficit to GDP ratio drops below 5% those have dropped, understandably. So let's take a look at where we are. So here is the deficit to GDP. It's at about 5.12%. And you can see it was moving in the right direction before the war. And we really thought it was going to drop below 5% and head for that 3%, which is Treasury Secretary Besant's goal for the end of 28. In fact, we thought that it was going to drop below that 3% well before the end of 28. Well, the war has changed that. Now, the defense budget is going up. And it was already at about $1 trillion. And just to put this in perspective, the deficit is at about, the total government spending is at about $7 trillion. And so one of that is defense. Two of that is health care. And one of the downward pressures on the budget is health care. We've heard about Medicare actually cutting prices dramatically in terms of some of the most heavily used drugs out there. We're also seeing DOGE continue to cut back on federal employment. And yet we do have this war. So the odds have gone down, certainly have, in the short term. But if we get past this period into fiscal 27, we think we'll have another shot at getting below 5% and heading actually very quickly to 3%. And the reason for that is we see GDP growing so much more quickly than many economists expect. But very short term, the odds have dropped. Here's another reason the odds have dropped, but this is a good news reason. I've mentioned on Past in the Nose the accelerated depreciation that was in the tax package last year. And you can see the impact already that it's having. So corporate tax receipts are going to be, I think, because of the accelerated depreciation, roughly $150 billion lower. Now, obviously, that's good news for the economy. It's one reason that we expect GDP growth to accelerate fairly dramatically in the not-too-distant future. And here, and we've presented these deficits together. I just showed you the federal deficit as a percent of GDP. Here's the other deficit that bothers, well, especially President Trump. I don't think it bothers too many other people, but his objective is to move us into surplus. And you can see we have spent many, many years in a deficit position. And from our point of view, we'll probably continue to spend more years in deficit. Why is that? It is because we think with the stimulative fiscal policy, especially that tax package, that the U.S. economy is going to boom relative to other economies. So we're going to be importing more than we export. Now, the other side of this, which takes away the sting that I think President Trump thinks exists, is a capital surplus. It means more investment dollars coming into the United States relative to our dollars going elsewhere in the world. So a capital surplus.
Cathie Wood's framework leads to a clear investment thesis. One Bitcoin as a new macro asset. Bitcoin is increasingly behaving like a global monetary asset, competing with gold and benefiting from falling interest rates and rising uncertainty. 2. Innovation will outperform. Companies and sectors driven by technological innovation are likely to see explosive growth as productivity accelerates. 3. Markets may be mispricing the future. If interest rates fall and GDP growth rises simultaneously, many assets are currently undervalued based on outdated assumptions. This creates a powerful opportunity, but only for those who understand the shift.